is recognized.
Thank you, Mr. Chairman. Thank the ranking member as well, and would associate myself with the comments of the ranking member, and would welcome all of the witnesses, but especially Mr. Benson, who has, of course, served from the great state of Texas. Good to see you again. I'd like to direct my initial question to Mr. Jarsulik. Sir, greatly appreciate your testimony, and I'm concerned about something that happened with Silicon Valley. It appears that it was, of course, the biggest bank failure in the US since 2008, the financial crisis, and I was here in 2008, and I recall a good deal of what happened, and the second largest ever. But it all took place in a 48-hour period. Social media played a role in it to some extent, and I'm concerned about the speed at which runs tend to move now. It's not like what I would call the old days when people talked by way of phone and they would try as best as they could to communicate. It seems that now what would take maybe a week would now happen overnight. Can you give some indication as to how being properly capitalized can be, or not being capitalized properly, can be impacted by these very fast runs?
Well, the speed at which a financial institution can face problems because its lenders depart can often be very, very fast. That is, as you point out, the uninsured depositors who departed from Silicon Valley did so very quickly. Right? Once they learned that there were potential solvency problems there, they were gone. I would say, though, that during the financial crisis of 2008, where social media was not such a factor, there was also an incredible rapid run on big banks. That is, the funding that they were doing via repo lending, which is often just overnight lending, vanished very quickly for certain classes of assets. The funding that they were able to obtain from asset-backed commercial paper, which turns over fairly quickly, also vanished very, very rapidly. And so I think that what happened with Silicon Valley is a great example of how quickly insolvency or perceived insolvency can affect an institution and the entire financial system. And so given that fact, there's a much stronger argument than is commonly recognized for very well capitalized, that is banks who have a very high level of equity financing. Because those banks, even if people get scared and decide to pull out some short-term funding that they have, those banks will remain solvent. That is, they will have assets that can more than cover their outstanding debt. And that makes them stable.
Thank you. You know, there are a good many people, sir, who contend that the banks already have enough capital on hand and that they could handle another 2008 crisis. How do you respond to those comments?
Well, I think in my testimony I gave a couple of examples of double-digit losses from banks that were allowed to fail in 2008 from Silicon Valley Bank. I would also draw your attention to work by a Chicago economist, Luigi Zingales, who, when things were happening in 2008, used information from the credit default swap market to estimate how much the largest 9 banks in the US would have lost but for intervention from Congress in TARP, from the Fed and other agencies. His estimate was those banks would have lost 22% of the value of all their assets had there not been intervention. Right? It's a paper that appropriately titled Paulson's Gift. And so given those data, given those estimates, I think much higher levels of equity are needed and would do a great deal both to improve the stability of the system, and increase the ability of these institutions to provide credit and therefore help economic growth.
Thank you, Mr. Chairman. I'll submit questions for the record.
Thank you. The gentleman, time has expired.